Breaking news: the United States Federal Reserve's new emergency bank term funding program was just introduced. The U.S. regulators are working to bail out customers of Silicon Valley Bank, which collapsed on Friday due to a massive run on the bank like withdrawals led by VCs. Treasury Secretary Janet Yellen said on Sunday that the federal government will not bail out SVB, but will help to try to meet the needs of depositors who stand to lose millions after the bank collapsed last week. The money to fully reimburse depositors of the collapsed SVB and the shuttered Signature Bank will be furnished by other banks, not taxpayers, Treasury officials said. The Deposit Insurance Fund, which will cover the deposits, is funded with quarterly fees assessed on financial institutions and interest on government bonds. Yellen also said that the plan would require congressional approval and that she hopes lawmakers will act swiftly and in a bipartisan manner. This plan would be subject to strict oversight and accountability measures. Yellen ruled out raising the deposit insurance limit from $250,000 per account, saying that it would create moral hazard and undermine financial stability. The plan also involves creating a special-purpose vehicle that would purchase assets from SVB and Signature Bank at fair market value, and sell them over time to recoup losses. The SPV would be backed by a $50 billion line of credit from the Treasury's Exchange Stabilization Fund, which is normally used for foreign exchange interventions. The plan would also provide a temporary guarantee program for uninsured deposits at other banks that have exposure to SVB and its customers, such as Wells Fargo and Bank of America. SVB had about $200 billion in deposits, of which only $50 billion were insured by the Federal Deposit Insurance Corporation. The program was announced on Sunday, March 12, 2023. In response to the collapse of Silicon Valley Bank, which led to fears of contagion in the banking system. Many of SVB's customers were tech startups, venture capitalists and hedge funds that relied on SVB for their daily operations and liquidity. The Treasury, Federal Reserve, and FDIC officials have worked with the Biden administration to develop facilities that would guarantee all uninsured deposits at SVB and provide emergency loans to affected customers. The program will make additional funding available to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors and address any liquidity pressures that may arise. The program will offer loans of up to 1 year to lenders who pledge as collateral U.S. Treasuries, agency debt, mortgage-backed securities, and other qualifying assets. The Treasury Department, using the Exchange Stabilization Fund, will provide $25 billion as credit protection to the Federal Reserve banks in connection with the program. The program is similar to the term auction facility that was used during the 2008 financial crisis. Yellen said that the collapse of SVB is a wake-up call for regulators to strengthen oversight and supervision of non-bank financial institutions, such as fintech firms and hedge funds, that pose systemic risks.